What's up? It's Martin here. Since this stuff isn't taught in school and one of you guys asked for it, today's video is going to be about how to master the use of a credit card as a student. Understanding how to use a credit card is quite simple, but since most of us are new to getting a credit card, it can be quite scary because we just got an extra chunk of money to play around with. And especially as young people, we might not be the smartest with that money, to put it lightly. That being said, the basic principle of a credit card is that you're borrowing money to make a purchase. And by a certain date, which is called the end of your billing cycle, you'll be expected to pay that amount back to the bank. The typical billing cycle is around 28 to 31 days, depending on the credit card that you have. And you should be able to easily check this by logging into your bank account and just checking when your statement is due. At this billing date, you have one of three choices that you can make. 1. You can pay the amount in full and you're basically clean. 2. You can pay the minimum payment, which is either a flat amount or a percentage of the balance that you owe, but you will have to pay interest on that amount on the next billing cycle. And 3. You either forget or don't pay the amount, and you'll have to incur bonus late fees, which is either a flat amount or a spike in your interest rate. However, I'm going to say that the first option is the only way you should be using a credit card if you're someone who is serious about being financially responsible, and I'm going to explain why. Whatever you do, don't go for the third option and forget to pay your bill. If you're someone who would forget, just know that you can pay your credit card early even before the end of the billing cycle. So while your transaction is fresh in your mind, you can go pay it off. Or you can just work up the discipline to schedule your billing cycle dates on your calendar so you don't ever forget to pay it. Another quick tip to mastering your credit card use is to set up a PAD or a pre-authorized debit, which will ensure that you at least make your minimum payment if you happen to forget to pay your credit card bill at the end of the month. This is usually an online form that you fill and send to your financial institution. You can easily find this for your bank by doing a quick Google search. This ensures that you'll basically never incur any late fees even if you forget to pay your bill. And as for the second option, if you think that you can get away with just making the minimum payment every month, then I suggest you think again. Let's just say that my credit card has a 20% interest rate, which some of you guys might be thinking, that's absurdly high. And you would be right, except almost all credit cards charge that high of an interest rate anyway. And let's just say I spend around, I'm going to make it up, $400 on this MCAT set of books so I can study for the MCAT. And I use this credit card to pay for it. At the end of my billing cycle, let's just say I pay a minimum payment of $25. This means that I still owe around $375 during the next billing cycle, but I have to charge interest on top of that. If this is the case and you decide to plug this into an interest calculator, because honestly, who wants to remember the math, right? Then it will take me over 1.5 years to pay down this $400, and I would have paid a good bit of interest on top of that. But consider this. If you're one of those people who would spend money like this, then you would definitely have made some other purchases on that credit card during those 1.5 years. And there's other factors that you should consider, like will you miss a payment during those times? And there's just so many other factors that can make this situation worse. Like what if you fall behind on one of your payments and you decide to purchase something else with that credit card? What do you think will happen? You're basically digging yourself a deeper hole. In fact, if you look back on my videos on personal finance, that you would see that I say that compound interest is basically the best thing since sliced bread, because just by saving and investing your money, you can save enough money to be financially independent and pay for everything yourself. However, if you misuse your credit card, you can have compound interest working for you in the opposite direction, which means that you'll basically have compounding debt, which can make you the opposite of financially independent, and it will be really hard to dig yourself out of that hole that you dug for yourself. Not only will you not be financially independent, but you'll have a whole lot of debt to pay off, and you might have to declare bankruptcy, which is not something that I would wish for anyone to go through. So basically, you can make the case that credit cards are basically loan sharks, except they're legal, which is also why some people swear that the credit card is basically the devil and will hang on to the debit cards and cash like no one else's business. However, I'd say that if you change your viewpoint a little bit and treat your credit card as if you're using a debit card, basically not spending money that you don't have on things that you don't need, you're pretty much guaranteed that you would be able to pay off the full amount that you owed by the time that the billing cycle is over. So basically, if you use a credit card in the way that I described in option 1, then you're pretty much on the way to mastering your use of the credit card. Now, if you hear this and you're thinking, what the heck, Martin? If using a credit card is like a debit card, then why even get the credit card in the first place? Isn't it the same thing then? That's a valid concern, and what I have to say to that is that credit cards are superior to debit cards for a couple reasons. First of all, credit cards have some little perks such as cashback. For example, the credit card that I have here gives me 1% cashback on groceries, pharmaceuticals, and gas, and 0.5% cashback on anything. And you might not think that's a lot, but it adds up over time. And as your credit worthiness goes up and you start making an income, you can obtain credit cards with even better benefits than what I listed. In fact, this is basically the bottom of the line because I have no income and I'm a student. Another thing is that credit cards have buyer's protection. So if someone steals your credit card and makes tons of purchases with it, you can call up your credit card to have them freeze it and have that money returned to you. Whereas if your debit card got stolen, then there's nothing that the bank can do for you because that's your money and now it's gone. This is because credit cards have their own insurance, and if someone were to steal your credit card and spend the money, then basically the credit card company can pay that back to you using their insurance pool, which this is a little bit more of a complicated concept, so I won't go into depth into explaining it. But know that credit cards have buyer's protection and debit cards don't. For example, on my other credit card, if I use it to purchase technology, then it has insurance up to around, I think, $1,000, just in case any technology that I purchase with this card gets damaged or stolen, I think within a year. Another thing that I can mention here is the concept of credit card churning, which is basically signing up for the credit card, spending a minimum amount in order to get perks or a bonus. For example, if you were to spend, let's say, $2,000 on a credit card, that they will give you $200 back as a promotion. Now, you might think, why do I need to spend $2,000? Wouldn't that mean that I'm $1,800 in the hole? Well, to that I say, if you had to use those $2,000 anyway, for example, to pay down your mortgage or pay down a car loan in the future, then that's money you would have spent anyway, and basically the $200 is the cherry on top. It's free. And that's just the tip of the iceberg. You can earn things like free travel and free hotel rooms just from doing this thing called credit card churning. I'll get into more detail about that in the future because I'm a student and I'm not making enough of an income to have any of those credit cards in the first place. So I'll get into that in the future once I had some experience doing it for myself. But if you're still not convinced and you're thinking,
I don't need to borrow money, I am smart
and financially responsible, then I'll have to go on to talk about credit score. Basically, what a credit score is a number or a figure that the creditor or the person that lends you money looks at in order to decide whether or not to give you a loan and what interest rate to put that loan at. What pops into my head for a loan is a car loan or a loan to buy a house, basically a mortgage, which are big items that not a lot of people will have a huge lump of cash. So for most people, you'll have to get a loan for that anyway. And having a high credit score will increase your chances of getting your loan and have it at a better, basically lower interest rate, so you don't have to pay as much extra on top of the amount that you're loaning out. And your credit score relies on 5 factors, and I'll put them on the screen right here. And they go as follows: payment history, amounts owed, length of credit history, credit mix, and new credit. And I'll quickly explain what each of these mean, but I'll link an article in the description below so you can read more about it. So for your payment history, which makes up 35% of your score, it's basically whether or not you pay your bills on time and if you miss any payments. So basically, if you listened to my points earlier in the video and you've had a good grasp of how to master the use of your credit card by paying it on time in full, then this should be a pretty easy section of your credit score to score pretty high on. 30% of your score goes to amounts owed, and basically what this score is looking at is whether or not you use a little or a lot of your credit. Being that if you use all of your credit, let's say you use $1,000 out of $1,000, then you're not as safe to lend money to because it looks like you're in desperate need of money, so you're just carrying a large balance on your credit card all the time. Whereas someone who is only using, let's say, $250 or $300 out of the $1,000 limit is viewed as more safe because they're not extending their position and taking out more money than they need to. And you might think, oh, if I have a larger credit line, like $10,000, and I use that same $1,000, I'm only using 10% of my credit. And that would be correct. So having more credit cards is not exactly a bad thing because it can help this section of your score by having a larger credit limit and lowering your credit utilization. Usually a good score for this is if you use less than 30% of what you're allowed to borrow. So if you have a $10,000 credit limit, then using less than $3,000 of that credit limit would give you a pretty good score in this section. Moving on to length of credit history, which makes up 15% of your score. This section looks at how old your accounts are, and I'm pretty sure that if your accounts are above 7 years or older, then that gives you a pretty good score. Basically, this shows the banks or whoever your creditors are that you've been paying these bills for a long time and that you've had experience dealing with loan money. So just know that the earlier you start using your credit card, the more it'll benefit your score in this section. And know that even if you have an old credit card that you don't use anymore, do your best not to cancel it, especially if it has 0 annual fee. This is to keep your average age of your accounts high, which helps 15% of your score. Let's just say you had this credit card for 10 years and you just got a new credit card that has a lot more benefits than your old one. And let's just say you decide to cancel your old credit card. Now you basically have 0 credit history. Whereas if you didn't cancel your old one and kept it, then the average age of your accounts would be 5 years. So keep that in mind. The other two sections, credit mix, which makes up 10% of your score, is basically takes a look at the different types of loans that you're taking out. For example, a car loan, student line of credit, just stuff like that. And it doesn't matter if you don't have a great variety because it doesn't make up that much of your score compared to the previous three sections that I mentioned. But if you want more information on that, then you can read the article that I put in the description below. And the last section, which is new credit, which makes up 10% of your score, is basically your lenders looking at if you've taken any new credit recently. And basically what this means is that if you're taking a bunch of new credit, then this will put something called a hard inquiry on your credit report. And if you have one too many in a short period of time before you want to get your big loan, then it can temporarily lower your credit score. So for example, a hard inquiry could be applying for a new credit card to get a new line of credit, or just getting a car loan or something like that. Basically what I'm saying is that before you try to get your big mortgage loan or whatnot, try not to apply for too many new lines of credit because that can affect your credit score and your ability to get that loan at a good rate. So now that I've covered the credit score, what I have to say is that if you're responsible with the use of your credit cards, then having a high credit score isn't as hard as it seems. And I know it's quite counterintuitive that you need to use credit and credit cards to even secure a loan. Because if you've never had the need to use credit before, then doesn't that show that you're already qualified to use money safely? This is just where you have to play the game, and basically using a credit card is to show them that I can borrow money and I can pay it back. If you use your credit cards wisely, then having a good credit score is not a problem, and I hope this helps you out in the future when you're trying to buy a house or a car. So in the end, just be responsible with your credit cards, and it's not as daunting as it seems. Even as an 18-year-old or a 19-year-old in my case, it's not that bad as long as you educate yourself early and educate your friends as well, because you don't want to see them in credit card trouble, right? So yeah, that's about it for this video. Smash the like button and hit subscribe with post notifications on, so you can see more content like this. And yeah, that's about it for me. See ya.